It is my second Polish Von Mises Institute event, and it is a true pleasure to be here with you to revive some friendships that started some 6 years ago. And it is also a real pleasure to be today at an event, the purpose of which is to better understand the ongoing euro area crisis. The ever-evolving and creative, to some extent, policy response to the crisis has shown, if anything, that its real causes remain still ignored. I will contend, together with the previous lectures, that the fractional reserve banking and central banking are at the root of the economic boom-bust cycle. But my main goal here will be to show how this same fractional reserve banking principle leads to further centralization and unification, as shown by the recent internationally sponsored economic stabilization programs in a number of euro area member states. To do this, I will first start with a stylized description of the present-day monetary order. I will briefly present a few causes of instability, which lead to precisely monetary unification and intergovernment cooperation. And as a matter of fact, these are two aspects of one and the same economic process that could be best labeled as monetary imperialism. And then within this analytical framework, as a kind of application, I will discuss the recent international assistance packages which were granted to euro area member states, and more specifically their three components, namely structural, fiscal, and banking policies. So let me begin with the stylized description of the current monetary order. It has two main features. Firstly, independent national central banks produce fiat paper monies, which implies the existence or rather coexistence of multiple paper money producers. Secondly, fractional reserve commercial banks, by the way, heavily regulated by domestic national authorities, issue fiduciary media of exchange. So let me start with an explanation of the inherent instability of a fractional reserve banking system before I dwell later into the international implications of paper money's political nature. The first cause of instability in a fractional reserve banking system is due to the fact that a relative change in the demand for different types of media of exchange results in a nominal change in the aggregate supply of money. For instance, a decline in the aggregate demand for cash, also called base money, is followed by an increase in the supply of bank credit and bank-created fiduciary media. Now, because banks keep fractional reserves only, the lower demand for cash, precisely because it is typically offset by an equally higher demand to hold deposits, creates extra liquidity for the banks. And this extra liquidity serves then as a foundation for a bank credit expansion which is much larger in size. In his early writings on monetary theory, Friedrich von Hayek himself, who is not typically known as a proponent of 100% reserve banking, has described this process as, I quote him, the most pernicious feature of our present system. Now, a second important implication of this most pernicious feature is that it disturbs the economic adjustment to relative changes in international demand. The heart of the problem is in the fact that a relative change in the spending pattern has implications again for banks' liquidity, and therefore for the total money supply through the money multiplicator. Thus, the market-driven adjustment to the new pattern of international demand through the restructuring of spending and production is automatically accompanied either by a contraction or by an expansion of the money supply. And this change in the money supply is acting as an independent cause for readjustment. And also it becomes an international transmitter of economic fluctuations through the impact on the interest rates. The influx of liquidity in the country with a positive trade balance implies a multiple bank credit expansion, which compresses the interest rate below its market level. This triggers the well-known business cycle which is the core of the Austrian monetary and capital theories. Entrepreneurs, to the extent that they do not anticipate the full consequences of the bank's induced monetary changes, are driven into an extension of the structure of production that is not sustainable given the existing pool of capital and net savings. And the end result is a physical impossibility to finish all production processes which have been started. And most importantly, the loss of value for all non-convertible factors of production. In other words, this results in a general impoverishment of society. Third and finally, the bust phase of the business cycle is destabilizing the fractional reserve system itself. Companies' bankruptcies lead to unrecoverable losses and to capital erosion for banks, which raises doubts about their own solvency. And the consequence is bank runs, either from retail clients or from fellow bankers on the international interbank market. This structural problem, which is embedded, so to speak, in the very notions of fractional reserve banking and bank credit, has found a technical solution, so to speak, in the institution of central banks, which act as unlimited lenders of last resort. Now, however, this short-term anti-insolvency expedient, as it could be called, is effectively promoting moral hazard and therefore an even less conservative behavior on behalf of the commercial banks. And this is nowadays shown by the very low levels of cash reserves and capital. Now, not to say that central bank monetary policy, through its infusion of liquidity, has become the main modern driver of the business cycles. Now, this calls for a further analysis of the economic instability that can be imputed to the very nature of modern central banks. What is the distinctive feature of present-day central banks? Well, it is their political and privileged position within the economy. The very framework in which paper monies are produced and introduced into circulation is fundamentally different from that of commodity monies. Commodity monies, which evolve out of the direct voluntary exchanges, are subject to the rules of what could be called horizontal and vertical competition. On the one hand, different commodities could be competing for fulfilling simultaneously the functions of a medium of exchange. Additionally, various producers of the same commodity can be competing for offering certification services with respect to the different monetary objects in the economy. But even more importantly, the producers of any of the commodities which serve as media of exchange must compete in the context of general scarcity with the producers of any other good. Now, this implies that on the market, an expansion of the money supply is costly, as factors of production must be bid up from other sectors. And in this way, the price mechanism, through its influence on the expected relative profitability of business ventures, naturally regulates the quantity of money in the economy, or would regulate the quantity of money on the free market. Now, this natural regulation of both the production and the purchasing power of commodity monies also ensures that those who venture into supplying the media of exchange in the economy do not benefit from a privileged position. Their income and wealth are positively affected if the demand for money rises relative to other commodities, including other media of exchange, of course. Inversely, a negative income effect would occur if competition intensifies or demand declines. So in a sense, competitive money producers on the free market must cope with the uncertainty related to the management of private property and could occasionally even be driven out of business, exactly as in any other capitalist venture. Most significantly, the fact that they supply the economy with a medium of exchange does not confer on money producers any special status that would allow them to claim more of the aggregate output of the economy than what they would earn on the market. And they would earn on the market as much as other property owners would voluntarily transfer to them through free and mutually beneficial exchanges. Now, with paper monies, things are altogether different. First, it should be emphasized that the acceptability of paper monies in the daily exchanges is rooted exclusively in the government's fiat. Given that they have no non-monetary utility, and therefore no alternative source for valuation, the foundation for ever accepting to hold paper monies comes from the legal certainty that any attempted rejection of the paper monies will be defeated by the government. Paper monies owe their existence to legal tender regulations enforced by governments. Now, this economic fact that we learn from value theory is important because it underlines that states and paper monies share a common feature, namely their coercive nature. One implication of this political nature of paper monies is that their production and supply entirely escape the discipline imposed by the market. Competition-driven cost considerations and consumer-determined return expectations are absent from the calculus of paper money producers. Indeed, the costs of producing 1 or 10 units of a given paper money are all identical. This implies that the marginal cost of increasing the money supply is de facto zero. And this in itself grants a very special privilege to any paper money producer, namely the capacity to acquire for free goods and services already produced by others. To quote Rothbard, a paper money producer could consume without producing and thus seize the output of the economy from the genuine producers. End of quote. The supply of paper money is then involved in nothing else but a special kind of exploitation, which could be labeled monetary exploitation, just to distinguish it from exploitation by means of taxation or by direct regulation of the economic activity. And now this makes it clear why paper money production is always legalized, protected, and de facto controlled by states, which do not admit of any rivalry, as we know from Hans Hermann Hoppe, in the exercise of their local monopoly of expropriation. So, given the lack of any natural, that is market-driven, check on the quantity of paper monies produced, there is a specific question which is of particular interest, namely the question of the limits on the money supply. And as a matter of fact, this is a problem with which money producers themselves have been confronted. How should monetary policy be conducted? This is a very valid question for a paper money producer. And it is precisely in the light of this question that the entire mainstream monetary research of the past century can be seen as an attempt to provide an answer to this apparently simple question. You can think of Friedman's K rule, of Taylor rule, of the optimal currency areas as different answers to how should monetary policy be conducted. Now, however, I believe that the large variety of mainstream de facto practical advice, not so much theoretical developments, has left somehow untouched the very core of the problem. And the issue itself is not that trivial, especially in the light of not infrequent cases of hyperinflation. Hyperinflation develops when expectations for a continual loss of purchasing power lead to a significant drop in the demand to hold money. And such expectations arise when monetary prices have been increasing already for a significant time span, which is itself the result of major increases in the money supply. And the typical central bank response to this situation is to further increase the money supply in order to address an alleged shortage of banknotes and of base money. This, of course, only feeds even more the inflationary expectations. And the end result of this vicious circle is a galloping increase in prices, galloping inflation, and a subsequent deteriorating capacity for money to intermediate exchanges. And in this situation, money users typically spontaneously turn to the use of an alternative medium of exchange, either commodity money, or in a world of multiple paper money producers, they turn to an alternative paper money. So from the outset, this would suggest that a paper money producer does not face any strict quantitative limit on its paper money production, save maybe for the extreme risk of getting evicted by other money producers. Now, this risk is crucial, as a matter of fact, from the point of view of the state, as it implies a significant loss in its exploitating capability. It also highlights an important limiting factor, namely the very existence of and rivalry between other paper money producers. The extreme case of hyperinflation also makes it clear that a paper money producer, despite all the legal tender legislations, ultimately relies on the individual's consent to accept its product. And this consent must be renewed time and again, and it is always relative to the quality of services rendered by rival monies. Indeed, any state which alone intensifies monetary exploitation faces either a gradual depreciation or a sudden devaluation of its currency relative to foreign currencies. And this very fact limits its capacity to further increase the money supply due to two factors. First, the loss of purchasing power means that a stronger increase in the supply of money would be needed in order to yield the same expropriation effect. And second, the public consent is significantly endangered when there is loss of purchasing power, and this could lead to a further depreciation of the currency. It is then clear that the obstacle in front of a single state to expand its monetary exploitation is the very existence of multiple paper money producers. And the solution to this conflict situation is to deprive rivals of their capacity to act independently. Now, this does not only help the state to increase monetary exploitation internally, it also allows it to grow externally and to enlarge the territory that it dominates. This tendency to expand monetary exploitation above the internal limits and beyond the current political boundaries is best characterized as monetary imperialism. And this is a term that I'm borrowing from Professor Hoppe, who mentioned it in an article from 2003, and which was independently coined some 30 years ago by a leftist writer. Now, the concept of imperialism, I believe, is indeed fully justified because the conflict situation persists and the tendency to expand for a dominant money producer does not vanish so long as the last rival has not been deprived of its independent control of the money supply. In a sense, monetary imperialism is in the very nature of paper monies and can be seen as a specific expression of the general conflict between rival governments, in particular with regards to money production. As long as there are multiple paper money producers, I would contend that the policy of monetary imperialism could not be avoided. In addition, the reality of this policy is guaranteed by the fractional reserve banking system itself. Because they are regularly weakened by the bust phase of the economic cycles, the inherently bankrupt fractional reserve banks drag the domestic states into bailing them out, thereby significantly endangering its financial condition and capacity to act independently. It follows that at any given moment, some paper money producers must be weaker than others. And according to a generalized progression theorem, which was formulated by Professor Huseman, political centralization and ultimate political unification is in the interest of both the financially strong and the financially weak political entities. So the very same weaknesses of fractional reserve banks that bring national central banks into existence also make sure that this centralization process is fully completed internationally. Commercial banks might even actively promote the submission to a stronger foreign paper money producer, given that they critically depend on the reliability of a serious and strong lender of last resort. I think we can identify two general forms of monetary imperialism. One is unification, and the other one is cooperation. Unification results in the effective reduction of the number of paper money producers. Monetary cooperation is less intuitive, a more subtle case, so to speak, of imperialism, as in this case the number of paper money producers is not reduced, even though for all relevant purposes they all act as one. And this broad classification will allow me now to present a reinterpretation of the present-day monetary arrangements and to discuss the recent bailouts in the euro area. So with respect to monetary unification, three distinct institutions that bring it about could be spelled out. And these institutions are dollarization, monetary unions, and the currency board. Dollarization occurs in cases of hyperinflation, when people spontaneously quit the domestic money and begin using a foreign paper money of better quality. The domestic money producer is evicted, while the foreign central bank gains an extension to its territorial monopoly. Recently, cases of official rather than spontaneous dollarizations have also occurred. In that case, an official agreement allows the otherwise evicted central bank to keep some form of existence and to share into the seigneurage of supplying the money supply on the national territory. And the most prominent current examples of dollarization include Ecuador, El Salvador, Uruguay, Nicaragua, Kosovo, Montenegro, and most recently Zimbabwe. Now the currency board addresses this issue of sharing seigneurage by design. The setup of a currency board always proceeds from an official agreement by virtue of which the domestic central bank declares that it will produce cash bank notes and replenish banks' reserves at the central bank, currency board, exclusively in exchange in foreign reserves. This is the reserve currency, and this according to a predetermined fixed conversion rate. Now, from an economic point of view, the domestic currency is no longer money per se, but a simple money substitute, according to the Misesian topology of monetary objects, a money substitute that is redeemable in the foreign money. In this way, the currency board effectively transfers the monopoly of money production to the foreign central bank. Its own specificity lies in the fact that the evicted central bank keeps its physical existence, while its economic nature is transformed from a money producer into a deposit bank. Real-world examples of currency boards, such as those in Hong Kong, Lithuania, Estonia, prior to the adoption of the euro, and Bulgaria still, have all operated on the fractional reserve principle. Now, this means that only a small portion of the foreign currency received by the board has been effectively kept in reserves, liquid cash. The vast majority of the currency received has been invested in interest-yielding foreign currency denominated bonds. And the yield on these securities has functioned as a partial compensation for the lost seigneurage that the currency board used to earn in its previous quality of independent money producer. And this financial benefit in the event of a currency board, if you compare it to a dollarization, also explains why currency boards have been so popular and more popular than dollarizations. Now, the third form of monetary unification, namely the setup of a monetary union, is very, very close in practical implementation. Should the single money of the union be already produced by one of the member states, then the creation of a monetary union consists in official, simultaneous, and multiple dollarizations. If a new money is to be introduced, then the setup of the Union must undergo an initial stage where the member states peg their currencies to the new currency. And in a sense, this new currency, which lacks a history of prices, and we know from Mises and the regression theorem how difficult it is to introduce a new currency. So this new currency must be born as a money substitute, initially produced by a de facto currency bond. And the next final stage consists in interchanging the nature of the monetary objects. So the money substitute becomes the real money, and the previously existing monies become money substitutes, which eventually disappear physically. And the different steps of the European Union, until the eventual physical introduction of the euro in 2002, perfectly fit into this three-stage sequence. Currently, there are two projects for establishing currency unions, one from the East African Community and another one from the Gulf Cooperation Council. Now, because monetary unions reduce the number of rival paper money producers, they allow for an increase in monetary exploitation. And the expected end result is higher inflation than otherwise, and a strengthened tendency towards further monetary centralization. In a sense, monetary unions facilitate the less straightforward form of monetary imperialism, namely intergovernment and intercentral bank cooperation. By coordinating their policy actions, that is by increasing monetary exploitation altogether, the paper money producers eliminate the disturbing divergent developments in the currency's purchasing powers. And thus users' consent is better secured as less viable alternatives are left. In addition, and interestingly, the permanent risk of bankruptcy of the fractional reserve banks encourages cooperation between paper money producers on an ongoing basis. Now, assume that the central bank decided to remain conservative and not to expand the money supply together with the other central banks. Its money would then appreciate relative to the other currencies and would keep appreciating so long as users expect the conservative central bank to keep its more prudent policy. Because its money keeps purchasing power better, its international demand increases, which would result into higher inflows of deposits at the commercial banks. Now, paradoxically enough, the conservative central bank loses its capacity to control domestic banks' liquidity. Furthermore, a sudden change in users' expectations could reverse the international flows of deposits and cause the illiquidity of the commercial banks, especially and mostly in the case where they would have used these liquidities for granting loans either in home or abroad. And the attempts of the central bank to recover control over the liquidity of the domestic banks, for instance by a sterilization policy, would de facto imply that a foreign-induced monetary policy has to be followed. So the extreme instrument for insulating the national banking sector from this phenomenon of hot money is to abandon the conservative policy early enough, that is, to cooperate with the others. And the recent case in point is the decision of the Swiss National Bank not to let the Swiss franc appreciate below 120 francs for a euro, a policy decision which was taken in July 2011 precisely because of significant inflows of foreign deposits due to the appreciation of the more conservative Swiss franc. From the point of view of the more expansionist central banks, so not the conservative ones, it is also in their own interest to cooperate even ex post. In other words, to provide support to foreign central and commercial banks in difficulty. A severe banking crisis in one country could undermine the stability of the fractional reserve banks elsewhere. And this is due to two factors. First, banks' balance sheets are interlinked through mutual exposures on the interbank market. And the second fact is due to the very low divisibility of confidence in banking. So despite their inherent rivalry, paper money producers do share a common interest, and this common interest is the avoidance of bank runs. And this is precisely in this light that we can interpret the coordinated policy decisions taken on several occasions between the five major central banks since 2008, and more specifically the US dollar euro swaps, which were meant to provide dollar liquidity to European banks which were lacking dollars. So monetary cooperation is an instance of the general intergovernment cooperation, which can take a second form of direct financial assistance through intergovernment loans. And this brings me to an analysis of these official loans, which have become very prominent in Europe. The structural weaknesses of the fractional reserve banks lead to often unforeseen bailouts, the magnitudes of which cannot be known upfront, and which results in sizable budgetary deficits. Now, this puts governments in a difficult financial situation due to the ever-increasing funding costs on the market for their securities. And beyond the point, the costs become so high that governments decide to stop issuing new securities and to look for an alternative funding option. And such an alternative is offered by the so-called official international assistance, which is typically dispensed either bilaterally or most often by the International Monetary Fund. And the outburst of the public finances crisis in the European Union has led to a wave of unprecedented intergovernment solidarity, we could say, which brought into existence a number of specific and still evolving instruments for granting aid to fellow members of the Union. And the latest of these instruments, the latest in date, is the European Stability Mechanism, which is a new permanent European institution mandated to lend up to 500 billion euros to euro area member states. And it is worth pointing out that this ESM evolved out of pre-existing balance of payment instruments, which are still there and which have been used for members of the Union which have not adopted the euro. So since 2008, 8 out of the 27 member states of the Union have received official assistance. Typically, funding has come from the IMF for 1/3 of the amounts, and the other 2/3 have been provided by the relevant European instruments. And the European Central Bank has participated in these official programs in order to provide continuous liquidity to the banking systems. So once the total loan envelope is determined, which is done in a very mechanical case based on the rollover of securities over the next 3 years and the expected deficits, effective disbursements of the loans take place in quarterly installments. After experts of the lending institutions review the policy progress and the implementation of the predefined so-called economic stabilization policies. So the economic stabilization program details specific policies and attached deadlines that the government must follow in fiscal, structural, and banking areas. And this is a de facto conditionality agreement between the lenders and the borrower. And the purpose of this conditionality agreement is to ensure that imbalances in the economy are corrected and that the funds are properly spent. So the overall impact of the official foreign assistance is determined precisely by this economic stabilization program. And to properly understand it, we must compare it to its counterfactual, namely how the fiscal and economic imbalances would have been addressed without foreign assistance. In a nutshell, this counterfactual would have consisted in a market-driven restructuring of both the economy and the public finances. So to begin with, the government's funding difficulties would have resulted into a restructuring of its spending. Expenditure cuts would have been simply unavoidable. The economic role of the high interest rates that private lenders begin to ask is precisely to signal the increased scarcity of funds to the government and to impose a lower expenditure pattern. Now, a self-imposed correction, which would have been based on higher taxes, would not convince the financial markets. First, higher taxes would not address the structural problem that is at the origin of the high public debt. And second, higher taxes would undermine the future productivity of the economy and therefore the capacity of the government to easily generate additional revenues. The adjustment of government expenditure to the available tax revenues would also automatically, or would have automatically contributed to addressing weaknesses in the economy's structure of production. A cut along all forms of subsidies would have led to the bankruptcy of businesses which were artificially maintained at a cost for the taxpayer. And the subsequently released factors of production, including labor, would have been redirected to sectors where they would be better employed, even though at a lower nominal remuneration. So a market-driven restructuring in government finances would, in a sense, have freed the economy from that part of the government's interventions which the lenders on the financial market would have considered excessive. The market-driven solution would also make the lenders aware of their own responsibilities. Beyond the point, the restructuring of the government activities would also include a rescheduling of the outstanding public debt, which would, of course, have implied losses for the investors in sovereign securities. Now, such losses would have resulted in an appreciation of the risk premium attached to public debt, probably on a permanent basis, and therefore in higher yields asked for investing in public debt. And this is the ultimate sanction that would have safeguarded long-term discipline in public spending. Now, against this background, an official economic stabilization program clearly thwarts, so to speak, the national adjustment process. In essence, the cheap official funding allows the government to maintain its overall size without scaling down. Nevertheless, because of the reality of the imbalances, which could have been hardly denied, the necessity for adjustment is fully recognized both by the official lenders and by the borrower. But now that the market-driven correction is precluded, the adjustment must take the form of administratively decided and implemented policy actions. Now, in a sense, I believe this sheds new light on the nature of the so-called conditionality, which is often presented as a means for avoiding the build-up of moral hazard caused by the cheaper than the market funding. Now, conditionality appears to be much more fundamental and implied in the very notion of intergovernment support. Because the market is not there to help the adjustment must be done in a centralized and administrated manner. And in addition, it is quite clear that if you look at the historical record of conditionality, it has hardly prevented a moral hazard. Now, the key problem with an administratively decided stabilization program is that it is trapped in an inescapable contradiction. On the one hand, the provision of sufficient financing to cover the government's funding needs over the next years reduces the urgency to adjust public finances. On the other hand, the policy conditionality itself is rooted in the awareness that an economic adjustment is much needed. And here there is a fundamental contradiction that leads to very low incentives to implement unpopular reforms. Now, it also implies that in practice, an official stabilization program is unlikely to succeed. The official creditors do not have sufficient knowledge of where the imbalances originate from. It is not enough to point at excessive public deficits and debt. One must also find which government programs and policies are at the origin of the unsustainable spending. And this is a knowledge that I believe rarely anybody possesses. At the same time, the assisted governments have little incentives to sort out their finances and to terminate practices that create financial holes. Why would the government fight bureaucratic resistance if funding is, after all, available? So the typical response to this knowledge and incentives problem is to impose only a very gradual correction path on the general public debt and to subsequently adjust the conditionality requirements to the effective progress made by the governments. Just to give you an example, the implementation of the policies is followed quarterly by experts from the IMF and the European institutions. This conditionality is written down in a specific memoranda of understanding or memorandum of economic and financial policies. And the purpose of the quarterly review missions is twofold. One purpose is to review how far the government has gone in implementing the conditionality, but the second purpose, of course, is to adjust the conditionality to the new situation and de facto to the level of implementation. So there is a very perverse link between imposing conditionality and modifying conditionality based on effective progress. So in a sense, while some broad expenditure cuts are imposed, it is fundamentally up to the borrowing government to specifically identify them and to implement them. So let me now examine in some further detail the economic consequences of the intergovernment support programs. So from the outset, an official loan implies the bailout of holders of public debt. So these are domestic and international banks or other investors such as pension funds, insurance funds, which of course also have exposure to commercial banks. And because the official loan reduces the likelihood for losses by private investors, the market price of public debt does not decline as much as it would have otherwise. So an official loan contributes to maintain the value of assets of investors in public debt above what their portfolio would have been in the case of a market-driven restructuring. It produces a counterfactual redistribution of wealth from taxpayers to the government's creditors, and most notably to the fractional reserve banks. Indeed, in fine, the official loan is to be repaid out of future taxes. Hence, an economic stabilization program implies stronger future taxation, that is, a heavier government weight on the economy. This is the exact contrary of the counterfactual market-driven solution, which would have resulted in scaling down the size of the government. An immediate first-round impact of an official foreign loan is to increase the liquidity of the domestic banking sector. This is due to the fact that part of the additional funding is spent on goods and services, including publicly employed labor, offered by residents. And as the government spends more than it would have spent otherwise, revenues of state-employed factors of production are higher, and so are, of course, their owners' deposits at the commercial banks. And the banks, which are the ultimate beneficiaries of the increased liquidity, can use it for repaying their own creditors or otherwise improving their profitability, for instance, by expanding bank credit. In a nutshell, a foreign-funded economic stabilization program is fundamentally inflationary or anti-deflationary. Even when it is nominally limited to supporting the government alone, it still contributes to refinance all debt-based relationships created by the fractional reserve banking. And given that these official loans prevent local episodes of deflation and thereby contribute to global inflation, we can definitely consider them as put in place as policies which find their origin in monetary imperialism. The specific economic policies that accompany the official loan fall in three areas: fiscal, structural, and banking. In the area of fiscal issues, it is required that the government gradually reduces its deficit over a number of years, typically 3 years, to a level which is considered sustainable. Now, this sustainability is determined very mechanically based on some growth projections and the subjectively determined acceptable level of public debt. In the European Union, prior to the crisis, the sustainability threshold for public debt was put at 60% of the gross domestic product, but since the crisis, it has de facto doubled. Similarly, deficit requirements are not determined anymore in terms of effective nominal targets, but relative to so-called structural targets, which of course allow for cyclical slippages in public spending during the bust. And finally, only part of the deficit correction comes from expenditure cuts. An equally popular and maybe even more popular tool have been tax hikes. And because these official loans typically result in increases in taxation, they have become an effective tool for international tax harmonization. And the fact that tax optimization opportunities for businessmen are reduced is a clear benefit to the foreign creditor states, which now also have the leisure to be able to increase taxes higher, given that tax evasion opportunities have been reduced. The so-called structural policies relate to the fundamental conditions of conducting economic activity, such as labor legislation, pension arrangements, state monopolies, protected professions, or different trade barriers of any kind. And the required adjustments in these areas are meant to increase the economy's overall productivity and competitiveness. The goal is to generate sufficient surpluses that would allow timely repayment of the overhang of foreign debt. However, it must be pointed out that structural policies also extend the notion of efficiency to areas such as tax collection, public finances framework, and again, tax evasion. So while structural policies do introduce higher economic freedom in some sectors, they also lead to a generally stronger government. In addition, much bolder and genuine reforms would have been implemented had the national authorities not received an official foreign loan. Quite often it is alleged that the conditionality attached to the loan is the best opportunity for domestic politicians to carry out and implement reforms that would have lacked social support and public consensus without the intervention of the international institutions. I believe, however, that this argument wrongly compares the structural reforms under the loan agreement to the situation prior to the government's financial difficulties. And this argument also ignores the impact, the very impact of the cheap official financing. Finally, the third policy area of an official program covers the banking sector. Now, measures here aim at ensuring that banks are adequately capitalized and provided with sufficient liquidity. Undercapitalized banks, whether effectively at a given historical moment or in light of expected losses over 3 years period included in the stress tests, receive state-funded capital injections, which are financed by the official foreign loan. Now, in the event where the undercapitalized bank would be deemed non-viable, restructuring and resolution are applied, such as dividing the bank into two institutions or consolidating it with another entity. Now, there is no need here to go into the detail of all possible banking sector restructuring measures, What we have to point out is a common feature. The common feature that must be recognized is that the fractional reserve principle of modern banking is maintained, while accidental changes to the business landscape are voluntarily accepted or sometimes even imposed. And the end result is that the banking sector is even more regulated, supervised, and de facto controlled by governments. Now, this summary of the stabilization policies required by a foreign official lender shows that genuine problems are being addressed by half measures. Even though some benefits could be expected in the long run from some of the structural policies, these are immediately offset by increased government involvement in all areas of economic life. And as a consequence, these administrative programs are bound to yield poor economic results. Now, of course, these poor economic results quite often, and already this has been the case, are quickly used as evidence for the need for further government involvement. And this can be seen as an application of Mises's interventionism theory, where the failure of one interventionist measure calls for a corrective second intervention. So there is a very perverse dynamic, so to speak, in these official programs, the lack of success of which is feeding further government involvement in economic life. In a nutshell, these economic stabilization programs promote anti-free market sentiment. But I believe we can go a step further and even claim that their macroeconomic consequences are fundamentally anti-reformist. First, the economic conditionality attached to the loan delays and even precludes some critical reforms. Second, the loan brings about a generalized bailout of all creditor to debtor relationships, and most importantly, an increase in the money supply. And both of these tend to maintain the social and economic statu quo. The higher future taxes, which are the necessary implication of a foreign bailout, put a burden on the future wealth to be produced by the economy. That is, on the younger generation. At the same time, the current owners of wealth, much of which has been accumulated in an unsustainable way due to the fractional reserve banks, are mostly shielded from bearing the losses. In this way, a bailout de facto hinders innovation, free entrepreneurship, and precludes the natural renovation of the economic elites, which a market-driven restructuring would have implied. Now, these conclusions are strengthened when we consider what would have been the specific impact of the market-driven restructuring on the banking sector. The unavoidable cuts in government spending would have resulted in a lower income for state-employed factors of production and subsequently in lower liquidity for banks. This would have led to a lower capacity of the economy to reimburse debts, to a surge in the non-performing assets on banks' balance sheets. These are things that we have seen, but most importantly, on the free market, so to speak, we would have had also as a result the need to acknowledge these losses, to fully bear them. And this would have resulted in a strong contraction of the money supply. This, as Maciej pointed, would have contributed to amplifying banks' own difficulties and most certainly to eventual bankruptcies. The fractional reserve banking system, in a sense, would have imploded in such a deflationary environment. And I believe that the main macroeconomic achievement and purpose of an official foreign loan has been to avoid precisely this outcome, namely to make sure that the money supply does not contract and that banks do not go bust. The end result is that financial instability remains embedded in our system despite all the official attempts to limit crisis. So the preservation of the fractional reserve banking, which I believe should be seen as the very rationale of the intergovernment cooperation, continues to build up additional imbalances, and of course, as a result, promotes further cooperation and monetary expansion. So, to sum up, my goal here was to show how the structural instability of fractional reserve banks, presumably shielded from bankruptcies by the central banks, becomes the main driving force of a process of monetary centralization and intergovernment cooperation. I tried to present the recent euro area crisis as an empirical illustration of this process, which is conveniently described as monetary imperialism. The official policy response to the imbalances, rather than addressing the root cause of the crisis, keeps the statu quo. It implies that the economy will be further weakened, which will result in renewed calls for state intervention and further policy initiatives. And thus, the policy of monetary imperialism, in a sense, persists and grows out of its own contradictions. Now, this conclusion, I believe, is important because it highlights the crucial Austrian insight, which we'll discuss to some extent later tonight, that in order to achieve international stability, the main component of monetary reform must be the banking reform. Thank you.
We have some 10 minutes for questions, so please.
So you seriously believe that in case of market-driven resolution or whatever you call it, there would be a push towards setting aside or extinction of fractional reserve banking?
Yes, fractional reserve banks, some of them would have to collapse. All the depositors will become the owners of the banks. So nowadays we are in a situation in which people believe that they are depositors, while as a matter of fact they are lenders.
Yeah, but the institution protecting fractional reserve banking have been in place for tens and hundreds of years, regardless of the financial crises and these international bailouts.
Yeah, so what we have now as international bailouts is basically the expansion of these domestic bailouts for which the central bank has been put into place in the first place. So I see this really as a further process of centralization of growing imbalances. You see, so indeed, I agree with you that historically the failure of fractional reserve banks to honor their claims have resulted in political calls to establish an entity that will bail them out. This is how we explain in Austrian economics the dematerialization of money, the appearance of the central bank, and its bailing out actions. I fully agree with this. And with the accumulation of imbalances and this process of monetary imperialism, as I described it, we have a growing next stage where the bailouts are conducted not only at the national level, at the domestic level, but at an international level through cooperation and so on. So I do agree with you that historically there is a little chance to see this happening. My point was just to compare theoretically what would have been the alternative in the event of lack of any intervention, national or international, in this area. I think the end result, if there is absolutely no intervention, would be a discovery of the fact that the deposit contract nowadays is mixing two natures into one. Depositors, de facto, are lenders as if they were regular creditors to the bank. And part of the imbalances in the economy comes precisely from the illusion from which depositors suffer, that they are not creditors to the bank, but precisely and only depositors.
The end game of monetary imperialism is one central bank, one global central bank with one money supply, correct? And the way you analyze it is in terms of the benefits of doing this to the individual central banks today. Basically just putting on the aggregate the micro-analysis we have with individual fractional reserve banks. I wonder if you can comment, because there's some costs involved as well, and for example, right now we've got competitive devaluations by central banks. It seems to me that you have examples where they would prefer not to be cooperating and not join, not want to be coordinated together. So there's a cost involved here as well that central banks might want to exhibit their own monetary nationalism in contrast to this imperialism.
Yeah, so if I understand you correctly, you would say that some industrial interests within the domestic territory would prefer to keep the currency for their own interests, the management of the domestic currency. I get the point, but maybe this can be easily offset by direct subsidies from the government. Right, I mean, the competitive devaluation is basically a forced redistribution from all the domestic holders of the currency through to some industries, which benefit from a positive income effect. It's a disguised subsidy. Maybe this cost and possible opposition to monetary unification could be offset by a direct government subsidy.
Yeah. Well, almost certainly as in the case of the Eurozone, where there's individual national central banks that would like to devalue and would like to exit the euro, at least they say this, but we're offsetting it through fiscal transfers.
Through fiscal transfers, exactly.
I was thinking more on the international level that you have an example of, say, the Bank of England and the Bank of Japan, the Fed and the ECB, all in some way trying to competitively devalue against one another, right, to gain a competitive advantage in the export market, especially in the case of the Bank of Japan. And they would prefer not to be coordinating these efforts, because if they do, then not everybody can devalue at the
same time. Yeah, no, I get your point. It's an interesting point. So again, I would say that fiscal transfers could solve this issue. But interestingly enough, I mean, all these banks now, central banks have started to exchange their own currencies. All of them, they have credit lines. They have repos, swaps. So I see this more as it is interesting that you bring this as an instance of competitive devaluations. I would see their actions more as cooperating actions. But probably they are both. So they are different aspects. So yeah, thanks for bringing this.
I would ask a question. What do you think of this new proposal of banking resolution reform in your opinion? Is like a step toward more market-oriented restructuring of banks?
No, I would take it as the other way around. So the reason they the European Resolution Authority and the European Resolution Fund are two parts to be implemented in the coming years of the so-called banking union, the first element of which is the single supervisory mechanism, which will start next year, by virtue of which the systemically important banks in the euro area will be supervised directly from the European Central Bank. Now, for the Resolution Fund, the idea of behind the policy, in the heads of the policymakers, is to break what they call this vicious circle banking crisis, public debt crisis. Because national governments are, or have been called until now to bail out failed domestic banks, the banking crisis has resulted, according to some, into the public debt crisis. And the idea of the Resolution Fund is to break this vicious circle, which would mean that a euro-wide or euro area-wide fund will be used to refinance failed banks at the national level. So it is not the Greek taxpayers which would be called upon funding the Greek banks, but taxpayers throughout Europe. Now, economically, what can we expect? So this would be a way to implement centralized or euroized public debt, so to speak. Now, the end result will be a moral hazard, I believe. Even less responsibility and even even more abuses by the national authorities from their national banks to fund public debt, domestic public debt, because the ultimate payer, the costs for expanding the domestic public debt will be borne by the foreigners, will be distributed throughout the euro area.
But does it not also include like changing like not senior debt into equity or?
So you're referring to something else here, which is the way in which banks in need of bailouts will be funded. So indeed, this is an initiative which would go rather in the right direction. So banks, before public funds would be provided to banks for recapitalizations, there will be a hierarchy of the contributors. First, the senior bondholders, the junior bondholders, second, the senior bondholders, and third, to some cases, it's quite vague there, large depositors. To some extent, this would go in the right direction, but then, of course, it would be also contradictory with the single resolution fund, which will be set up out of public funds. Why would you need a single resolution fund if you announce and imply already that future bank recapitalizations will be done primarily by private funds? There is something strange there for me. And the only way I can make sense out of it is that really the policy response coming from the policymakers has been extremely contradictory the last years. On the one hand, they want banks to deleverage because they see imbalances. On the other hand, they want banks to get involved into providing credit to small and medium enterprises because otherwise growth cannot be restarted. Now, you cannot have one and the other at the same time. So this is just another instance of how the policy response goes into two contradictory directions.
And how do you find the role of fiscal treaty in this whole picture?
Cosmetic. Fiscal treaty is not an innovation. There were principles before for maintaining fiscal discipline and responsibility, but they failed.
There was that six-pack.
The six-pack, yeah. There are a number of initiatives, and one is losing sight of this.
And after they made six-pack, they started to work on fiscal treaty.
Like always with these elements, if you read only the big lines, it all looks very fine. But when you start to look all the exemptions, for instance, the deficits are defined in structural terms. So again, the deficit limit in the six-pack is in structural terms, which allows for cyclical slippages. And this has led to the subjective appreciation of policymakers themselves. So there are a number of initiatives which I believe are there to calm financial markets, which go on paper to the right direction, to implying more fiscal discipline. But when you look into the fine print, I have my doubts as to the capacity of these legal initiatives to lead to more discipline.
So you do not believe that all these regulations inside European Union like six-pack and above European Union like fiscal treaty, you do not believe that it could be effective?
I have my doubts. These are definitely initiatives in the right direction again. But why do I have doubts? Well, the big doubt is that this is again administratively solving the issue. The issue can be solved on the market if one respects its obligations with respect to debt and to repayment. And it's a little bit like central planning in determining the quality of your finances. If you compare this with a private individual, well, you determine the state of your indebtedness based on your expected income, your capacity to increase it. It's not, a kind of economic approach to your indebtedness. These policy initiatives completely discard the possible economic regulators of public indebtedness and go for an administrative solution. That's why I have my doubts that this can succeed. And historically, as we see, the Maastricht criteria were permanently abused. So why would now new criteria be respected?
Why do you criticize focusing on structural deficit?
Because the structural deficit is an artificial construct. The real deficit is the difference between your spending and income. You can design the structural deficit in many ways. I mean, this is an artificially constructed concept. You have to take out the so-called cyclical component. How do you determine the cyclical component? By a change in the methodology, I can show you that you have a structural surplus, while you have a deficit of 30% based on your receipts. I mean, you take a deficit of 10% to GDP in Spain. This is basically 30% more than what the Spanish government has as receipts. And I'm more or less confident that by some methodology, I can show you that the Spanish government has a structural surplus.
Your colleagues in the European Commission counted, so how do they count?
I don't know. These are big methodologies. I'm not involved in this at all. Eurostat has methodologies. I do not know. But this makes me only more suspicious.
Okay, thank you for that once again.
Still, you can use different methodologies to count deficits. Still, you can use different forecasting. So it's something like structural.
My point was that the real variable is the difference between how much you get and how much you spend. And this is the only thing that matters. Then you can provide different explanations to this. And basically, the distinction between structural and cyclical is a justification of why you spend so much. But the major point is that you spend too much. Why? That's another matter. We can discuss it. And in the legal documents, six-pack, this kind of justifications are already embedded. This is the only thing that I want to say.